Hello and welcome. In this lecture video, I'll be talking about the basics of financial statement analysis, some key terminology, and then also discussing horizontal analysis and vertical analysis. So when we talk about financial statement analysis, some of the purposes would be to provide internal users better information to make decisions, and also to provide external users with information. So, for example, in terms of a creditor, if we want to borrow money from a bank is going to go through and look at our financial statements and calculate a series of ratios. They may calculate, for example, the current ratio, current assets divided by current liabilities, or they may calculate the quick ratio, which would be a subset of current assets called quick assets divided by current liabilities. And they'll be looking at how well our company does in relation to different benchmarks. That really helps them in their decision to lend us money, and also in their decision to which interest rate they should charge us. Okay, so all kinds of decisions are made with financial ratios, and this whole chapter is dedicated to calculating different financial ratios and also horizontal and vertical analysis. There's some more terminology that we need to talk about. Liquidity talks about the ability to meet short-term obligations and to generate revenues. Really, the ability to meet short-term obligations. Do we have enough cash to pay for utilities, to meet payroll? Those are liquidity issues. Solvency is related to more long-term obligations. Profitability refers to pretty much what you would think it is, which is the ability to generate a profit. And so we could have some ratios along the lines of profitability, such as calculating the profit margin or the gross margin ratio or the profit margin ratio. And then also we have the idea of market prospects, the ability to generate positive market expectations. We might be thinking about a ratio that would fall along these lines over here called the PE ratio, the price to earnings ratio. So when we talk about ratios in more detail throughout the lecture videos for this chapter, we'll divide our ratios in terms of liquidity, solvency, and profitability, and also market prospects. Before we talk about ratios, I want to talk about horizontal analysis and vertical analysis. Okay? So when we talk about horizontal analysis, what we're really referring to is comparing a company's financial condition and their performance across time. So there's a couple ways that we could do this. We could show comparative financial statements. So for example, we have a balance sheet here, and we're showing our assets, cash, short-term, accounts receivable. We're showing it by year. And so you can see right over here, we're showing our financial amounts side by side by year, and then we can show a dollar change, and then we can show a percent change. So you can see, why is it called horizontal analysis? Because you're comparing across time like this, across time. So that's why you're comparing it horizontally across time period. That's why it's called horizontal analysis. And so again, what we do with horizontal analysis in terms of the balance sheet, we could break out all the components of our assets, and we could do the same for our liabilities, and showing them for each year, side by side, calculating a dollar change, and then also calculating a percent change. Okay? The other thing that we could do in terms of horizontal analysis is conduct a trend analysis. Okay? So if we look over here on this next page, you can conduct a trend analysis. And again, with horizontal analysis, it can be done for the balance sheet, or it could be done for the income statement as well. It doesn't have to be just the balance sheet. The example I was just showing you right there was for the balance sheet. Now I'm going to show you an example of trend analysis using the income statement. So with the trend analysis, what we do is we calculate out a trend percent. And the way that we do that is we take our analysis base period divided by our base period amount times 100. So you can see right over here, we have 2006, 2007, 2008, 2009, 2010. And let's assume that 2006 is our base period. So what we're going to do is for each category, revenue, cost of sales, and operating expenses, we're going to show each category by year as a percentage of this base amount. So if we look over here, that's the way we do it. So we can see with 2006, that's 100%, right? That's the base year. And with 2007, what we can do, if we're looking at in terms of revenue, how did we get 147% right there? And how do we get 290.9% right there? What we did is we took our 3 million, which is our analysis period amount, divided by our 2 million, which is our base period, times 100, and then that gives us our trend percent. For 2008, we took our analysis period divided by our base period times 100, and then that gave us about 291%. So we can do that for each category on the income statement there. And this is a high-level income statement, of course, right? Then what we could do is we can show that through a line graph to show how those change over time. And it's a little difficult to see right there, but in terms of your course pack, if you're looking at it online, you would be able to see that the trend line for revenue is falling short of the cost of sales. So cost of sales is rising faster than revenue when you look at this trend line. And that's a problem, because what that means is that our gross margin is, or gross profit is calculated by taking our sales minus our cost of goods sold. Our gross margin is going to start to fall. Our gross profit will start to fall. And also the magnitude of that difference between revenue and cost of sales is increasing. So it's growing over time, and that's a problem for gross profit in the future. And then, of course, also net income in the future, assuming that operating expenses don't decrease, right? And so when we look at that trend and we analyze that trend, we should basically say that management should attempt to control the cost of sales. Now, whereas horizontal analysis was looking at performance over time, vertical analysis, which is also called common size income statements, common size balance sheets, helps us evaluate individual financial statement items in the context of a base amount. Okay? So if we look over here, we can say we're going to calculate a common size percent. We're going to take our analysis base amount times 100. Okay? And so basically what we'll do, if we look over here, this gives us a really good way of looking at it in terms of our common size balance sheets. So what we could do is we could say we have our balance sheet, just the assets portion. We have our cash and cash equivalents, so on and so forth. And so what we want to do with our common size, is we want to calculate these common size percentages, okay? We can show it for 2010 and 2009. So the way we calculate this 15.2% is I take my total cash as a percentage of my total assets. So I take 1,550,000 divided by 10,204,000, multiply it times 100, and then that gives me 15.2%. And I do that for each year, 2010 and 2009, and for each line item on the balance sheet. And I can do that for the income statement as well. Okay? I can do the exact same thing for the income statement. Now, when we're talking about the balance sheet, our base amount, see the base amount right over here? That's our total assets. And for 2009, 835 divided by our 8101, our base amount is total assets. So the base amount when you're doing the common size income statement, which is a type of vertical analysis, the common size balance sheet, which is vertical analysis for the balance sheet, you use total assets as the base. Okay? Use total assets as the base, so you're putting every single item on the balance sheet as a percentage of total assets. When we look at the income statement, the base amount is total revenue. The base amount is total revenue. So if I take my cost of sales right over here, I have my 2010 and 2009, and how did I get 56%? I took my cost of sales as a percentage of my revenue. How did I get 44%? I took my gross margin as a percentage of my revenue. Research and development as a percentage of my revenue. So the base amount, the denominator, is always revenue. Okay, and I can do that for 2010 and 2009. And then, of course, I just multiply it times 100 to turn it into a percent. Okay, so what I want you to do now is go further in your course back and find this problem. Okay, I want you to find this problem. It should be towards the end of your Chapter 17 notes in your course pack. And I want you to go ahead and pause the lecture video and see if you can't calculate common size percentage and trend percents like I just reviewed, and then we'll review it together, okay? Okay, so let's see how you did. In terms of the common size, remember that with our common size income statement, sales is the base. So for example, in 2012, that's why in 2011, sales is always 100%. And then I calculate cost of goods sold, and I showed you how I did it here for 2012, is I took my cost of goods sold as a percentage of sales. So remember, with our common size income statement, we express everything as a percent of revenue, or in this case, we don't have any other revenue, so it's just total sales. So 290 divided by the 540 times 100 gives us 53.7%. Okay? And then we do the exact same thing for gross profit. We take our 250 divided by our 540, and of course in 2011, 240 divided by 460, and 220 divided by 460 for this number. Okay? Now with our trend percent, what we do is we have 2011 is the base year, so that's all 100%, and then we express 2012 as a percentage of 2011. So for example, to get my sales of 117 right there, I took my 540 divided by my 460 times 100, that gave me 117. For my 121, be 290 divided by 240, and then here 250 divided by 220, and that's how I got that number of 114. Okay, so with the trend percent, 2011 is the base year. With our common size income statement, sales is the base year, but remember, if you're doing a common size balance sheet, total assets would be your base. Okay, all right, this concludes this lecture video, and the subsequent lecture videos I will start to talk about different financial ratios. Thanks.